So let's work on our first consolidation. Here we have Wisconsin and Badger. Their balance is before the purchase, and then they give us the details of the purchase. So the purchase was paid with some debt and stock, so a balance of debt and stock. So let's do the journal entry for that, and then we'll post the journal entry here and update Wisconsin's balance. So what was the investment? Well, let's add it up. So the first thing they did was they borrowed some money. They issued some stock, 15,000 shares, $10 par, $40 fair. So we have to put $10 of it in the par account, and the excess over par, which would be 40 minus 10, that 30 per share has got to go in the additional paid-in capital. So for all the 15,000 shares times 10, and the 15,000 shares times the difference between the 40 and the 10. So that, wait a minute, we got a little decimal issue there. Okay, so the cost of the investment would be all three of those added up. That's the total that they paid. And then they also paid some professional fees and some stock issue costs. So professional fees are expensed when they're incurred, and the stock issue costs reduce the paid-in capital. So the professional costs were the did they say what the professional costs were? Paid a broker, okay. And then the stock issue cost would just be a debit to this additional paid-in capital here, and then there'd be a payment when they pay both of those. So what we want to do is take this activity here and post it in here. All right, so no change to sales, but there is an expense. And so net income is going to be, excuse me, that's going to be a positive number because it's showing here as a credit. So positive numbers are debits, credits are in brackets here. All right, current assets are going to go down because cash is in current assets. And then the investment in Badger, of course, is going to go up. Liabilities are going to go up. We're going to show that as a credit. Common stock's going up. We'll show that as a credit. And then additional paid-in capital is going to go up by the 450 and down by the 40. And then retained earnings negative. We're actually going to put a positive. We're reducing retained earnings here. So let's just make sure that all of our subtotals work fine. Okay, so our assets equal our liabilities for the adjustments. That's a good sign. And so now we can update the balances here. And then just check the balances, make sure we don't have anything backwards. We're still in balance. Okay, so we're in good shape there. Now we want to do the consolidating entries, and the consolidating entries remove the investment account and the related equity in the subsidiary and remove the excess of fair value over book value. So let's go ahead and do that. Your textbook uses a convention of assigning a letter to the entries, and that's to help you remember to do them all and to sort of signify them. I always do them in order with the letter. You don't have to do the letter, but it certainly is helpful. So the purchase price was the $900,000. We've got to check for fair value over book value. The book value of Badger is assets less liabilities, or you can just add up all of the all of the equity accounts. And then the equipment over fair value. So the equipment right now is at $600,000. It's worth $700,000. So we need to add that $100,000 difference to bump that up to fair value. And then they've got this patent. It's currently on the books at $300,000. It needs to be $280,000. So we actually have to write that down because the book value is greater than fair value. And then goodwill would be the difference. So we take the $900,000 and subtract out these items, and we have goodwill of $50,000. So we are going to book these adjustments in our consolidating entries. The first one is the S entry, which is to remove the book value of the subsidiary. So let's do that. So the S entry will remove the book value of the subsidiary. So there's the book value. That would be debited. Ending retained earnings. So that's that book value, that whole 770 now. That book value is being removed here. That's the S entry. That's to remove the book value of the subsidiary from the investment account. Now let's remove the excess of fair value over book value. So that means we've got that's the A entry. All right, so for the patent, we actually have to reduce it. For the equipment, we're going to increase it. We're going to put the goodwill in there, and then the net of all of those will be to the investment account. And if you've done your entry correctly, the investment account plus any debits minus any credits should be zero. It should zero out. And in order to show all the activity and not hide it inside the cell, we like to make the investment account a multi-line account. So everything in that box is really just that one account. Okay, so that's the convention there. All right, so now that we've done our entries, there's a couple of things I like to do. One is I just want to be sure my debits equal my credits. And actually, I usually do that first so that I stop after each entry and make sure that it's working. So here my debits are equal to my credits, so I'm feeling okay about that. So now then I'm going to get my consolidated amounts. So we bought Badger on this date, and so the sales and expenses prior to this date, because this was prior to the combination, don't belong to us. We're going to gray that out. So the consolidated sales is just going to be with Wisconsin. The consolidated expenses will just be with Wisconsin. All right, now the assets are going to be for both of them. Assets go up with a debit and down by a credit. All right, let's add up total assets and see if we're going to be balancing. We didn't get that 50,000 in there. There we go. Okay, so let's do liabilities now. So the liabilities of both firms. And get the math here. Now the ending retained earnings is going to be from above, so let's get this calculated. Okay, let's see if we balance. Okay, so we balance. That's great. So there is your first consolidation.